Hey everybody, welcome back to Financial Modeling 101. This is the fourth video. It is the second part of the income statement two-part video. So last video we went through and calculated revenue. So if you haven't watched that one, go back and check it out. But this video is going to be spent looking at the other half of the income statement, which is the expense side of things. So what we're going to be going over in this video is really more about budgeting expenses. The methodology behind calculating expenses is a little bit less complex, or actually quite a bit less complex than the methodology for calculating revenue, but it's really important nonetheless. Um, we break this all out in this expense category here, and there's really a couple different categories of expenses. So we have COGS, or cost of goods sold. So these are expenses that are associated with gross profit, and they are meant to capture the costs, the incremental costs of delivering your product to a customer. So the idea behind cost of goods sold and gross profit is to try to get a handle on, as you scale as a company, which costs are going to scale with you almost at a 1-to-1 ratio, just to get a sense of, if you sell a product for $1, how much of that dollar do you actually collect to start chipping away at your overhead or your operating costs. So um, the way I like to explain it is, if you have a 50% gross margin, which means that about 50% of your revenue, or that 50% of your revenue is there is a 50% cost associated with that revenue. It means that every time you sell something for $1, you're really only getting about 50 cents. So we have that in this section here labeled cost of goods sold. And then we have the other costs associated. These are like operating costs. So you have COGS, cost of goods sold, and then below cost of goods sold are all of your operating costs. So uh, in this model, we're calculating all of headcount as operating costs. In reality, you can allocate people's salaries up into cost of goods sold, but we're not doing that in this model. So we just have headcount sections. This is where we're going to input all of our employees, and then we just have other kind of miscellaneous general costs that we have budgeted for. So in this case, we have rent, utilities, professional fees, and then other costs. In reality, depending on your business, depending on your cost structure, you can add a bunch of different categories. If some of these don't apply to you, then you can take them out. But the idea is to try to capture all of the costs associated with your business and then budget for them here. So we have, there are some other costs associated with the income statement that aren't in this section, and we'll get to those at the end. But these are the costs that you need in order to calculate EBITDA. So that's earning before interest, taxes, depreciation, and amortization. And then there are some other costs that are kind of below the line item that we'll go over at the end of the video. And some of those we'll go through in more detail on the balance sheet section as well, right? So just to go over some of the calculation methodologies that we're using here, there's a whole bunch of different ways that you can calculate costs, kind of like there's a whole bunch of different ways that you can calculate revenue. In this case, since we're trying to capture this as like the 1-to-1 scaling, like as you grow, how to cost scale with you. For our cost of goods sold, we're just going to use it as a percentage of revenue. This is generally how I've seen cost of goods sold calculated, is as a percentage of revenue, but there's different ways that you can do it. I've seen it done a bunch of different ways. In this case, we're just using hosting costs, payment processing costs, sales commissions, and then we just have kind of like its other miscellaneous catch-all category here. You can do this a bunch of different ways. You can assume that as you scale, your cost of goods sold is going to get more efficient. You can get that percentage of revenue down, so you could have it kind of like going down over time and calculating it out this way. But the way that we've done it is we've just said 10%. This is an input right here. And then we calculated revenue, which is in the last video, just that times that. And then we just take that exact same logic and then we map it down for each of these individual costs. right? That's how we do cost of goods sold. Our head count is a little bit more difficult from like a formula perspective to calculate, but let me walk you through from a formula how it works. So you can see up here how this is all working. We have to use an if statement for salaries, but basically what it's saying is you have the name of a person here. So whoever this is, their salary, in this case, we have it at $70,000. We're taking that and we're dividing it by 12 to get it into a monthly amount. And then we're multiplying that by 1 plus their benefit rate, which in this case is 20%. And what this if statement is doing is it's saying if this date at the top here is greater than or equal to this date here, which is an input, which is the start date, then we want to include this calculation. And if not, we're going to make it 0, right? So so this is where, planning out your hiring plan can be pretty interesting. So if you want to do John Smith, if you want to see if you can hire John Smith for 120,000, and you're going to see if you want to do this in maybe March, then you can see that's how that works. That's how this calculation works. And what you'd want to do is you'd want to put in all the people you're paying today and then forecast out future hires to see what that does to cash, what that does to your income statement, your margins, all that stuff. The rest of this stuff is pretty cut and dry. We just inputted a monthly cost here with the year-over-year growth rate. So the way that this calculation is working is it's just saying essentially take this cost, and then we're using this year calendar to calculate out the incremental years. So every time that there's a new year, we're going to multiply by 1 plus 20 or 1 plus 20%. So you can kind of see how this works. It's 2,000, 2,000, 2,000. As soon as it goes up to the next year, so year 2 goes up by 20%. And then we use that exact same logic for the utilities expenses, legal, accounting expenses, other expenses we just have as a percentage of revenue as a kind of like a catch-all, just to be conservative and make sure that we have kind of a bucket, a buffer there. And then we have a tax rate in here as well. Okay, so this is how all the calculations work. And again, you can add in whatever expenses are pertinent to your business. And what I'm going to do now is I'm going to jump over to this tab to the right, the financial statements tab. And we're going to look at how the income statement is laid out from a formatting perspective and what it all looks like. So as you can see up top here, we have revenue, which was calculated on the assumptions tab that we went over last video. Now we have all of our cost of goods sold, which if you remember is just a percentage of revenue. That's how we modeled it. And it's just linked to that assumptions tab right there, which gives us, this is a sum. Total cost of goods sold is just the sum of all of those. And as we can see, our revenue minus our cost of goods sold gives us our gross profit. In this case, it's a 72% gross margin, which means if we sell $1 of revenue, we get about 72 cents of that. And then we have all of our operating expenses. So this is the head count. These are the people. This is just the sum of that assumptions calc, what we just went over. Then we have rent, utilities, the professional fees, and that other, which if you remember is just the 5% of that revenue. Then we sum up. These are all of our operating expenses. EBITDA is just going to be this gross profit right here minus your operating expenses. So, a lot of times people that are investing in your company or like, especially like at the later stage, they're really interested in EBITDA as opposed to net income. The main reason for that is EBITDA reflects kind of the operations of the company. There's a lot of things that can affect net income that don't necessarily affect EBITDA. So for example, if you have a lot of debt and you're paying a ton in interest, that's something that can be fixed just by recapping the business. Whereas EBITDA, there's less noise like that. So it's usually more interesting. So I mentioned a little bit earlier that there's a few other expense categories that aren't associated in operating expenses that do affect the income statement. One of these is depreciation. So we'll go over this in detail in the next video, which is where we're going to be covering balance sheets. But this has to do with fixed assets. So just to kind of address it briefly here, what this is meant to do is take the money that you spend on fixed assets. So these are big expenses, things like, large scale equipment that cost, hundreds of thousands, millions, or whatever, that you spend one time, but you'd like to kind of spread that cost over the life of the equipment. You do that on the income statement with depreciation. And that's where this goes here. And like I said, we'll go through that in more detail in the next video when we cover balance sheets. There is one additional line that I need to address here that's not on this model, but there will be there needs to be a line between EBITDA, and then you have EBIT, which is earnings before interest and taxes, which is just EBITDA minus depreciation. There's actually another line in here, which is it's just EBT, which is EBT, and earnings before taxes, which is where you actually take out the interest that you're paying. So for this particular model, we don't have any debt. We don't have a loan amortization schedule. But what you would do is you would take the interest portion of debt that you have on the balance sheet, and this is where you'd subtract out any interest payments that you have. So again, it's something that can affect net income, but doesn't necessarily affect EBITDA. But we have EBIT here, and then we have the taxes, which we inputted on the assumptions calc over here. So these are being taken out, and then you have net income, which is just EBIT minus those taxes to give you a net margin. So we'll go through some different scenarios and how you can play around with some of your assumptions and get to different outcomes on the income statement in the next video. But hopefully, or I'm sorry, in a couple videos from now, whenever we go over scenario analysis and go back and analyze the financial statements. But hopefully this was helpful in understanding some of the calculation logic behind expenses, as well as the structure of income statements. And we will continue on going through discussing the calculations and the structure of the other three statements. Next video is going to be the balance sheet, and then the video after that's going to be the statement of cash flows. So be sure to check out those videos to get a holistic picture on how the three statements are structured and calculated. And I will see you all in the next video.